In this video, we are breaking down a powerful take from Dan Ives, who says this is a generational opportunity in AI software. He recently joined CNBC to talk about the software sell-off, current valuations, and why the market may be getting this whole AI story wrong. I am going to show you the clip of Dan Ives first, then I will come back with my own reaction and detailed breakdown of what he said. After that, we will dive into 3 software stocks that I believe AI cannot disrupt. If you find value in this video, hit the like button, share it, and let me know your thoughts in the comments. Make sure you subscribe so you do not miss the next important investing update. Let's hear what Dan Ives has to say.
I mentioned at the top of the program that you moved a couple of really beaten down names into your AI 20, that being Salesforce and ServiceNow. What do you make of what Jensen said amidst all of this skepticism about that space?
I think the hearts and lungs of the AI revolution will be in software. Now, look, right now it's data center build out, GPUs. I mean, you're still in the early days of this, it's going to be a 10-year build out. But software is going to be key to the use cases. I mean, it goes to our point. If you look at Palantir, and ultimately followed by Snowflake and Mongo, in my opinion, to say Salesforce and ServiceNow are structurally broken companies, to me, look, in my career, I think it's the most disconnected call that I've ever seen. Investors thinking that software is not going to play a huge part of the AI revolution.
It will. That's not to say that certain ones aren't being disintermediated in a extraordinarily large way, or there's a belief, if they're not today, that they will be tomorrow, right? As Brad Gerstner was telling me, you're not selling these stocks because you are so upset with what's happening today, but you now more than ever need to see some justification for the multiples that these stocks have commanded. Let's take that. What's the PE of Salesforce and ServiceNow? Can we show that? There it is. So, okay, Salesforce is down to 15. The forward on service is almost 25. Is that justified?
Well, it's my view that like the monetization, because like when I look at the revenue for a ServiceNow or a Salesforce, I could argue there's 20-30% incremental revenue from where they are today. We're talking, ultimately tens of billions of dollars, when it comes to Salesforce, that are not factored in to the valuation, because I get in the near term it's a headwind. Benioff, I think, would be the first one to admit it. But to say that Salesforce and ServiceNow, given how integrated they are in enterprises, in the stack, you look at the hundreds of thousands of customers, as these use cases play, you haven't seen it today, but in the next 6, 9, 12, 18 months, I think what Jensen talked about is exactly right. You cannot paint all of them with the same brush. You can't just say an SMB pure play they're going to be impacted as much as a Salesforce, an Adobe, a Workday.
I mean, not everything has traded miserably, but obviously so many have. I mean, when you look at all these companies, how do you know what justifies a higher multiple versus ones that don't? We showed a pretty good discrepancy in the forward PEs of both of these names, which have equally gotten hammered. Can you look at a Salesforce and say, okay, at 15 times earnings, that stock has corrected enough that it looks attractive, but just because you can make that case for one doesn't necessarily mean you can make it for the other, but you are.
Because I view it as, Salesforce is the one, if there's one name that's been so dislocated relative to what I believe the opportunity would be, it's Salesforce. And I could also argue some of the cybersecurity names like Palo Alto and CrowdStrike. When I look at ServiceNow, betting against McDermott has been the wrong move. If you look at that install base, now look, I could say they were early on in terms of AI, and now they're really sort of being viewed as they're going to be disintermediated. But Scott, like I've talked to 40, 50 CTOs, CSOs, IT managers over the last week to make sure, the stress has to make sure that I'm not looking at it wrong, and I feel further conviction in this
but can you just those? That's like asking people on the football team, hey, how's the team? Everybody's like, hey, we're great. Everything's great. Can you trust that you're getting the best opinions on what's really happening by asking the people who are at the companies where their stocks are declining? Aren't they all trying to?
Well, I'm talking about the buyers. I mean, the buyers of Salesforce, the buyers of ServiceNow, the buyers of cybersecurity. And I feel I come away viewing this as, I'd say it's a generational type of opportunity in terms of what's happening in software.
Okay. Let me ask you this. Microsoft got downgraded today by 𝗗𝗟𝗡, which says, quote, Satya lost the AI narrative. I know you're going to counter that, but doesn't the stock kind of worry that 𝗗𝗟𝗡 is right?
Yeah, and Ben, an analyst, who I have huge respect for.
Is there a
but the AI revolution is not going to be successful unless Microsoft's successful because of how integrated they are in enterprises, in Azure, in the backyard of, ultimately really the core enterprises movement to AI. Have they hit some sort of perception soft spot here relative to Azure, relative to CapEx in terms of that not all being allocated to Azure? Yeah. But I think this is one where, when I look at Microsoft, I think it's a stock that has a 5 in front of it and a 6 in front of it over the next 12, 18, 24 months. I just think near term, right now, it's a guilty till proven innocent.
Well, I mean, how do they prove themselves to be innocent? 𝗗𝗟𝗡 suggests today that they need to increase their CapEx markedly. That's the word that they use, not me, to keep pace with what Google and Amazon are doing. So their free cash flow, at least in the near term, is going to take a big hit. Isn't the market, aren't investors going to have a problem with that?
I think investors clearly, you've seen that since the quarter, right, in terms of the sell-off. My view is that when it comes to Microsoft, they're not going to have to increase CapEx maybe to the level that they're talking about, as well as also when it comes to the enterprise, the monetization, they've only monetized 5% of their enterprise customers. That's why I'll bet on the Dell and Redmond to navigate this. Look, right now, it's, there's obviously very negative sentiment, and I get the call.
Dan starts by framing the AI revolution in a way that I personally agree with. He says the hearts and lungs of AI will ultimately live in software, not just hardware. Right now, all the attention is on data centers, GPUs, and the massive infrastructure build-out. NVIDIA is the poster child for this phase, and Jensen Huang's comments clearly reinforce that idea. But Dan makes it clear that this is just the early stage of what he views as a 10-year transformation. Hardware is the foundation, but software is where AI actually turns into real business value. This is where his view really clashes with current market sentiment. Investors have been dumping enterprise software stocks like Salesforce and ServiceNow, basically acting as if these companies are either broken or about to be replaced. Dan calls that belief one of the most disconnected calls he has seen in his career, and that is a strong statement coming from someone who has seen multiple tech cycles. I think what he is reacting to is the idea that people are treating all software companies as if they are equally vulnerable to disruption, when in reality their positions in enterprise stacks are very different. He brings up Palantir as an early example of software benefiting from AI, and then points toward names like Snowflake and MongoDB as next in line. From his perspective, it makes no sense to say that Salesforce or ServiceNow are structurally broken when they are deeply embedded into hundreds of thousands of enterprises. I tend to agree with him here. These platforms are not optional tools, they are core systems of record and workflow engines. Replacing them is not like switching a consumer app, it is a multi-year, high-risk decision for large organizations. The conversation then shifts into valuation, which is really where the fear is coming from. The host points out that Salesforce is trading at around 15 times forward earnings, while ServiceNow is closer to 25. The question is whether those multiples are justified in a world where growth has slowed and AI benefits are still mostly theoretical. Dan's response is that the market is being myopic. He argues that there is potentially 20 to 30% incremental revenue upside that is not priced into these companies at all. In the case of Salesforce, he is talking about tens of billions of dollars over time. Now this is where my own opinion starts to diverge slightly. I agree with the long-term opportunity, but I also understand why the market is hesitant. AI revenue is still more promise than proof for many of these companies. Enterprises are experimenting, not fully committing yet. That creates a timing problem. Investors want justification today for multiples that assume future success. Dan acknowledges the near-term headwinds, but he is clearly willing to look past them. He also makes an important distinction that I think gets lost in a lot of bearish arguments. You cannot paint all software companies with the same brush. A small business-focused SaaS company is not facing the same AI risks or opportunities as a deeply entrenched enterprise platform like Salesforce, Adobe, or Workday. That nuance matters, and the market often ignores it during sell-offs. When asked how to separate the winners from the losers, Dan gets very specific. He says Salesforce is the most dislocated name relative to its opportunity. In other words, if there is one stock where fear has overshot reality, it is Salesforce. He also mentions cybersecurity names like Palo Alto Networks and CrowdStrike, which he sees as similarly mispriced. With ServiceNow, he makes the case that betting against 𝗗𝗟𝗏 has historically been a losing strategy. Leadership and execution matter a lot in enterprise software, and that is something spreadsheets do not always capture. One part of the interview I found both interesting and a little questionable was when Dan talked about speaking with dozens of CTOs, CISOs, and IT managers to stress test his thesis. He comes away with even stronger conviction, but the host pushes back, comparing that to asking players on a football team how the team is doing. Of course, they are going to sound optimistic. That skepticism is fair. People who are invested in a platform are often biased toward defending it. Still, I think dismissing that feedback entirely would also be a mistake. These are the people actually making purchasing decisions, and their behavior ultimately matters more than market narratives. Dan frames the current moment as a generational opportunity in software, and that is probably the biggest takeaway from this part of the interview. He believes we are in a transition phase where fear is dominating facts, and that creates opportunity for long-term investors who can stomach volatility. The conversation then pivots to Microsoft, which adds another layer to the discussion. Microsoft was downgraded with the claim that Satya Nadella has lost the AI narrative. Dan strongly disagrees. He argues that the AI revolution simply does not work without Microsoft because of how deeply integrated the company is across enterprises, Azure, and core infrastructure. I personally lean toward Dan's view here. It is very hard to imagine large-scale enterprise AI adoption that does not involve Microsoft in some capacity. That said, he does admit there is a perception problem right now. Concerns about Azure growth, capital expenditures, and how much spending is truly being allocated to AI have put Microsoft in a guilty until proven innocent position. Dan still believes the stock has significant upside over the next 1 to 2 years, but the market clearly wants proof. When the host brings up the idea that Microsoft may need to sharply increase capital spending to keep up with Google and Amazon, it gets to the heart of investor anxiety. Higher capex means lower free cash flow in the near term, and markets hate that. Dan pushes back, suggesting Microsoft may not need to go as far as critics think and pointing out that enterprise demand is still largely untapped. He mentions that only a small percentage of Microsoft's AI capabilities have been monetized so far, which implies a long runway ahead. Overall, my takeaway from this interview is that Dan Ives is making a long-duration bet. He is not arguing that everything looks great today. He is arguing that the market is extrapolating short-term uncertainty into permanent damage. Whether he is right or not will come down to execution. AI needs to translate into real revenue, not just demos and pilot programs. But if it does, I think he is right that many of these software names will look absurdly cheap in hindsight. This was less about hype and more about conviction in enterprise gravity. Software that is deeply embedded does not disappear overnight. It evolves. And according to Dan Ives, AI is the next evolution that the market is currently underestimating. Now let's break down the 3 software stocks that AI cannot disrupt because they are already deeply embedded into the infrastructure, data flows, and monetization engines of the modern digital economy. The first company we are going to talk about is Cloudflare, ticker symbol NET. Before we talk numbers or valuation, it is important to understand why Cloudflare actually matters in the real world. Cloudflare sits at the intersection of the internet, security, performance, and application delivery. It operates one of the largest global networks in the world, with infrastructure spread across hundreds of cities, sitting directly between users and the websites, applications, and services they access every single day. This position is critical because it allows Cloudflare to act as a gatekeeper and optimizer for internet traffic. Every request that flows through its network can be inspected, secured, accelerated, and optimized in real time. That is not something that can be easily replicated, and it is certainly not something AI can simply disrupt or replace. In fact, AI depends on this type of infrastructure to function efficiently at scale. Cloudflare is not just a security company, and it is not just a content delivery network. It is a programmable edge platform. Developers and enterprises use Cloudflare to run code closer to end users, reduce latency, improve reliability, and secure applications from increasingly sophisticated threats. As applications become more distributed and data-intensive, this edge-based architecture becomes more important, not less. One of the biggest misconceptions about AI disruption is the idea that smarter models automatically eliminate the need for infrastructure. In reality, AI dramatically increases the demand for fast, secure, low-latency networks. Cloudflare benefits directly from this because AI-driven applications generate more traffic, more API calls, and more security risk. Every one of those factors strengthens Cloudflare's value proposition. What really gives Cloudflare a moat is the scale of its network and the data advantage that comes with it. The company processes an enormous volume of internet traffic every day that allows it to identify threats, patterns, and anomalies faster and more accurately over time. The more customers it adds, the better the platform becomes, which creates a powerful flywheel that is extremely difficult to disrupt. From a business model perspective, Cloudflare is built on recurring revenue. Customers typically start with one product, often security or performance, and then expand usage over time as they add more services. This land and expand strategy drives strong net retention and steadily increasing customer lifetime value. It also means revenue growth does not rely on constantly finding new customers, but on deepening relationships with existing ones. Financially, Cloudflare has been executing well. Revenue growth has remained strong even during periods of macro uncertainty, which speaks to how essential its services have become. Large enterprise customers now represent a growing portion of revenue, and those customers tend to be more stable, more sticky, and more willing to adopt additional services over time. Margins have been improving as the company scales, and while Cloudflare continues to invest aggressively in network expansion and product development, the path towards sustained profitability is becoming clearer. This is not a company sacrificing fundamentals for growth at all costs. It is a company deliberately building infrastructure that will support the internet for decades. From a long-term investor perspective, Cloudflare stands out because it benefits from multiple secular trends at once. Internet traffic continues to grow. Applications are becoming more distributed. Security threats are becoming more complex. AI workloads are increasing data movement and latency sensitivity. Cloudflare sits directly in the middle of all of that. AI does not disrupt Cloudflare. AI increases the need for what Cloudflare provides. That is a critical distinction that many investors miss when they lump all software companies into the same risk category. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the second company, 𝗣𝗚𝗏, ticker symbol APP. 𝗣𝗚𝗏 is one of the most misunderstood software businesses in the market. At a surface level, many people see it as just another advertising technology company. That view misses the core of what makes 𝗣𝗚𝗏 unique and durable. 𝗣𝗚𝗏 is a software platform that helps developers grow, monetize, and optimize their applications at scale, primarily in mobile environments. What makes 𝗣𝗚𝗏 especially resilient to AI disruption is that it is not fighting AI. It is built around it. The company's core advantage lies in its proprietary software that uses advanced data modeling and machine learning to optimize advertising performance in real time. Its platform continuously learns from massive volumes of data to improve targeting, pricing, and user engagement. This is not a business where AI comes in and replaces the product. AI is the product. 𝗣𝗚𝗏's technology improves as more data flows through it, and that creates a self-reinforcing loop. The more developers and advertisers use the platform, the better its models become. That improvement then attracts more users, which feeds even more data back into the system. Another key factor that makes 𝗣𝗚𝗏 hard to disrupt is switching costs. Developers integrate 𝗣𝗚𝗏 deeply into their monetization stack. Once it is embedded, ripping it out and replacing it is not trivial. Performance matters a lot in this space. If a platform is consistently delivering higher revenue per user and better lifetime value, developers are reluctant to change. 𝗣𝗚𝗏 also benefits from scale. It operates across a massive number of applications and users, which gives it a broader data set than smaller platforms could ever hope to achieve. That scale advantage compounds over time and raises barriers to entry. Financially, 𝗣𝗚𝗏 has gone through a major transformation. The company streamlined its business, divested non-core assets, and focused intensely on profitability and efficiency. That shift surprised a lot of investors who had written the company off as overly aggressive or unfocused in the past. The result has been strong margin expansion, improved cash flow, and a much clearer long-term story. Revenue growth has re-accelerated as its core software platform continues to gain traction, and operating leverage has become more visible as the business scales. What I find most compelling about 𝗣𝗚𝗏 is that it sits at the intersection of software, data, and monetization. As more economic activity shifts into digital and mobile environments, the need to efficiently monetize user attention does not go away. If anything, it becomes more competitive and more data-driven. AI actually raises the bar in this industry, Platforms that do not have deep data, strong models, and proven performance will struggle. 𝗗𝗏𝗏 already operates at that level. It is not being disrupted by AI. It is one of the companies defining how AI-driven monetization works in practice. From a long-term perspective, 𝗗𝗏𝗏 represents a business that has already adapted to an AI-centric world. It has demonstrated the ability to generate strong returns on capital, improve margins, and scale profitably. That combination is rare and valuable, especially in software. Now let's move to the third company, MongoDB, ticker symbol MDB. MongoDB is a foundational piece of modern application development. It provides a flexible, scalable database platform that allows developers to build and run applications that handle massive amounts of unstructured and semi-structured data. In an AI-driven world, that capability becomes more important, not less. Traditional rigid data structures struggle when data types become more complex and unpredictable. AI workloads often involve diverse data formats, rapid iteration, and real-time processing. MongoDB was designed for that environment from the start. What gives MongoDB a strong moat is developer adoption. Developers choose MongoDB because it is easy to use, flexible, and powerful. Once a development team builds an application on MongoDB, switching databases later is costly, time-consuming, and risky. That creates significant stickiness and long-term customer relationships. MongoDB has also successfully transitioned from a traditional licensing model to a cloud-based, consumption-driven model. This aligns revenue more closely with customer usage and growth. As customers build more applications, process more data, and scale their workloads, MongoDB's revenue grows alongside them. AI does not eliminate the need for databases. AI massively increases it. Models need to be trained, updated, queried, and integrated into applications. All of that requires robust data infrastructure. MongoDB sits at the core of that infrastructure. Financially, MongoDB has shown strong revenue growth driven by cloud adoption and expanding customer usage. While the company continues to invest heavily in research and development, it has also made progress toward improving operating leverage as it scales. Large enterprise adoption has been increasing, which is important because those customers tend to have more complex workloads, higher lifetime value, and longer retention. MongoDB's platform is increasingly viewed as mission-critical rather than optional, which strengthens its long-term position. What separates MongoDB from many other software companies is that it is not selling a nice-to-have tool. It is selling a core system of record for applications. AI does not replace that role. It depends on it. When you step back and look at these three businesses together, a clear pattern emerges. They are not software companies trying to pivot into AI to stay relevant. They are software platforms that already form the backbone of digital infrastructure, data, and monetization. Cloudflare controls how data moves securely across the internet. 𝗗𝗏𝗏 optimizes how digital attention is monetized at scale. MongoDB manages how data is stored and accessed for modern applications. These are not fragile positions. They are deeply embedded roles that become more valuable as complexity increases. AI increases complexity. It increases data volumes. It increases performance demands. It increases security risk. All of those trends play directly into the strengths of these businesses. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. When you compare Cloudflare, 𝗗𝗏𝗏, and MongoDB, which business do you think has the strongest long-term moat as AI adoption accelerates, and why? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.